There is a secret looming over the American stock market, a secret so vast, so systemic, and so terrifying that Wall Street analysts are implicitly forbidden from speaking its name on live television because it would trigger an immediate panic. It is the secret of the walking dead. If you look at the S&P 500 or the Russell 2000 indices today, you see record highs, you see green arrows, you see a booming economy that has supposedly defied gravity and ignored the laws of physics. The narrative is that the Federal Reserve has engineered a miracle, that interest rates can stay high without breaking anything. But if you look closer, if you peel back the skin of the market and look at the actual balance sheets of the companies you own in your 401k, your pension fund, and your ETFs, you will see something rotting. You will see that nearly 20% of the companies listed in the United States are technically insolvent. They are zombie companies. This is a technical economic term, not a metaphor. It means they do not generate enough operating profit to pay the interest on their own debt. They are not growing. They are merely existing. For the last 15 years, they have survived only because money was free. They borrowed from Peter to pay Paul. They refinanced their way out of bankruptcy. They lived on the life support of 0% interest rates and quantitative easing. But yesterday, a report from Moody's, one of the world's top credit rating agencies, landed on the desks of every major CEO and fund manager, and it contained a number that stopped the hearts of the banking elite: $1.8 trillion. That is the amount of corporate debt that hits a maturity wall in 2026. This isn't theoretical debt that can be pushed off for decades like government debt. This is hard, corporate cash that must be paid back or refinanced within the next 12 to 18 months. Here is the nightmare scenario. These companies borrowed that $1.8 trillion back in 2020 and 2021 when the Fed had rates at zero to save the economy. They locked in interest rates of 2% or 3%. It was free money. They used it for stock buybacks, executive bonuses, and ill-advised acquisitions. Now the bill is due. They have to refinance that debt. But the window has closed. They now have to refinance at 8%, 9%, or 10%. Their interest payments are not going up by 10% or 20%. They are about to quadruple overnight. For a healthy company, this is painful. For a zombie company, it is fatal. They cannot pay it. They have no cash reserves. They have no profits. They are dead. They just haven't fallen over yet because the calendar hasn't turned to 2026. And while the retail investor is still buying the dip, banking on a soft landing, Warren Buffett is already dressed for the funeral. He has liquidated billions in assets. He is sitting on a record $382 billion cash pile, the largest war chest in the history of capitalism. He has sold the banks that lent money to these zombies. He has sold the retailers that depend on their employees. He has sold the manufacturers that supply them. Buffett's silence is the loudest warning signal in financial history. He knows that in 2026, the maturity wall will become a firing squad. We are facing a wave of defaults, bankruptcies, and liquidations that will make the 2008 financial crisis look like a minor correction. In 2008, the banks were the problem. In 2026, corporate America is the problem. But here is the paradox. While the zombies die, a new class of king companies will rise to take their market share. The destruction of the weak is the opportunity for the strong. Buffett isn't just hiding, he is preparing to buy the wreckage. In this deep dive video, we are not just going to analyze the problem. We are going to open the balance sheets and the history books to reveal the 5 rules of the bankruptcy cycle that Warren Buffett is using right now. These are the rules that will help you identify the zombies in your own portfolio before they go to zero, and position yourself for the greatest wealth transfer of the decade. To understand the scale of the carnage that is coming, we have to look back. We have to understand that this has happened before. The market has a short memory, but debt cycles are as predictable as the tides. We need to look at the 1980s junk bond era and the collapse of the Nifty 50 in the 70s. In the late 1960s and early 70s, investors were obsessed with one-decision stocks, companies you could buy and hold forever, regardless of price. Polaroid, Xerox, Eastman Kodak. They were the magnificent 7 of their day. They traded at insane valuations, 50, 60, 70 times earnings. The narrative was that they were invincible, but when inflation spiked and interest rates rose in the 1970s, their cost of capital exploded. Their debt became expensive. Their valuations collapsed. Investors lost 90% of their money in safe blue-chip stocks because those companies couldn't grow fast enough to outrun the cost of money. Then, in the late 1980s, we saw the junk bond boom led by Michael Milken and Drexel Burnham Lambert. They revolutionized finance by allowing weak, risky companies to borrow massive amounts of money. This fueled a boom in mergers, acquisitions, and leveraged buyouts, LBOs. It felt like the party would never end. Companies were borrowing money just to pay the interest on previous loans, a classic Ponzi scheme structure. But in 1989 and 1990, the cycle turned. The Fed raised rates to fight inflation. The maturity wall hit. Companies couldn't refinance. Drexel Burnham Lambert collapsed into bankruptcy. The entire savings and loan, S&L industry was wiped out because they held these toxic bonds. The economy went into a recession that cost George H.W. Bush his presidency. We are living through a narrative echo of both these periods combined. We have the overvaluation of the Nifty 50, the AI tech bubble, combined with the structural rot of the junk bond zombies, the Russell 2000 and private equity. Buffett lived through both. In the 70s, he avoided the Nifty 50 mania and bought boring businesses with no debt and high cash flow. In the 90s, he stepped into the wreckage of the junk bond crisis. When everyone else was panicking, he bought preferred shares in Salomon Brothers and other distressed assets for pennies on the dollar. He became the liquidity provider when the market ran dry. He knows the cycle. It has 4 distinct phases. Phase 1, cheap money creates zombies, 2009-2021. Rates at zero allow bad businesses to survive. Phase 2, rising rates expose zombies, 2022-2024. The tide goes out, revealing who is swimming naked. Phase 3, the maturity wall kills zombies, 2025 to 2026. The loans come due and cannot be paid. Phase 4, the survivors take everything, 2027 plus. The companies with cash buy the assets of the dead for cheap. We are currently transitioning from Phase 2 to Phase 3. The signs are everywhere if you know where to look. Chapter 11. Bankruptcy filings are at a 10-year high, rising 40% year over year. Corporate defaults are ticking up. The vultures are circling. The signal Buffett is sending by holding $382 billion in cash is simple. I am not going to lend money to a dead man. He is waiting for the bodies to surface so he can pick their pockets legally. We need to deconstruct the hidden mechanism of this crisis. Why is 2026 the year of death? Why not 2025? Why not 2027? Why is everyone talking about this specific date? It comes down to the term structure of debt. When the pandemic hit in 2020 and 2021, the Federal Reserve slashed rates to zero and bought corporate bonds to save the economy. Corporations went on a borrowing binge. It was the greatest debt issuance bonanza in human history. They issued 5-year bonds like there was no tomorrow. They locked in rates of 2% or 3%. They thought they were geniuses. Do the math. 2021 plus 5 years, yes, 2026. That is the maturity wall. $1 trillion tsunami of 5-year bonds comes due next year. Here is the mechanics of the trap. When a corporate bond matures, the company rarely pays it off with cash from operations. They don't have that kind of money lying around. They roll it over. They issue a new bond to investors to get the cash to pay off the old bond. It is a refinancing game. In normal times, this is fine. It keeps the wheel turning. But these are not normal times. The old bond cost them 3% interest. The new bond, issued in the environment of 2026, will cost them 8% or 10% interest. Why? Because the Fed rates are higher. But more importantly, the credit spreads, the risk premium banks charge, are widening because banks are scared of defaults. For a zombie company that operates on razor-thin margins, think of a struggling retailer, a legacy media company, or a highly leveraged gym chain, tripling their interest expense is impossible. Let's look at the numbers. If a company has $1 billion in debt at 3%, they pay $30 million a year in interest. They might make $40 million in profit. They are alive. If they refinance that $1 billion at 9%, they have to pay $90 million a year in interest, but they only make $40 million. Suddenly, they are losing $50 million a year just to service the debt. They have 3 options. Dilution. Issue new stock to pay the debt. This crushes the share price and wipes out existing shareholders, you. Asset sales. Sell their best assets to pay the debt. This leaves them a shell of a company. Default. File for Chapter 11 bankruptcy. The stock goes to zero. The bondholders take the keys. The employees lose their jobs. It happens instantly. One day the company is trading on the NYSE. The next day it files. The mechanism is automatic. It doesn't require a recession to trigger it, although a recession makes it faster. It just requires the calendar to turn to 2026. The math creates the crisis. Buffett sees this calendar. He knows that the Russell 2000 index of small-cap companies has a debt-to-EBITDA ratio that is terrifying. He knows that nearly 40% of the Russell 2000 companies are unprofitable. He knows that private equity firms are loaded with portfolio companies that cannot survive at 5% rates. He is staying away from the entire sector. Now, we pivot to the practical solution. How do you ensure you aren't holding a bag of dead stocks when the wall hits? How do you protect your retirement from the zombie apocalypse? We are going to break down the 5 rules of survival that Warren Buffett uses to filter out the zombies and find the kings. Rule number 1. The interest coverage. Litmus test. This is the most important metric you will learn today. Forget PE ratios. Forget revenue growth stories. In 2026, the only metric that matters is the interest coverage ratio. This ratio is calculated by taking a company's earnings before interest and taxes, EBIT, and dividing it by its interest expense. If the number is below 1.0, the company is a zombie. It is losing money just by existing. It is borrowing to pay interest. It is terminal. If the number is below 2.0, the company is in the danger zone. A small drop in earnings, recession, or a small rise in rates, refinancing, kills it. Buffett looks for companies with a ratio of 10.0 or higher. He wants companies that could pay their interest 10 times over without blinking. Warning on EBITDA: be careful. Many companies use adjusted EBITDA, where they add back all sorts of fake costs to make themselves look profitable. Use real EBIT, operating income, real money. The simulation. You own stock in a popular streaming service or a meal delivery app. You love the product, but you check the interest coverage ratio. It's 0.8. They are burning cash to pay debt. In 2026, they try to refinance. The bank says no. The bond market says no. They have to issue equity, diluting you by 50%, or file for bankruptcy. Your stock collapses 80% in a week. Your action: open your brokerage account. Look up the financial statements of your top 5 holdings. Calculate the interest coverage ratio. If it is below 3.0, sell it. You are holding a ticking time bomb. Rule number 2. Cash is oxygen. Net cash versus net debt. In a credit crunch, cash is not just an asset, it is oxygen. Companies with net cash, more cash on hand than total debt, can hold their breath forever. Companies with net debt suffocate immediately. Buffett holds Apple. Apple has a net cash position, or very close to it depending on the quarter. It is a fortress. Buffett holds Berkshire Hathaway. It has huge net cash. He avoids utilities or telecoms with massive debt loads unless they are regulated monopolies that can raise prices by law. The simulation. The credit markets freeze in 2026. Banks stop lending. Company A has $5 billion in debt and $100 million in cash. They need $1 billion to operate. They can't get it. They liquidate. Company B has $5 billion in cash and zero debt. They see Company A liquidating. They buy Company A's customer list, patents, and factories for pennies. Company B's stock doubles because they just acquired a competitor for free. Your action: filter your portfolio for net cash companies. These are the survivors. Rule number 3. Avoid the roll-up scams, private equity traps. Many popular stocks today are actually roll-ups, companies that grew by borrowing money to buy other smaller companies. This works great when debt is cheap. It is fatal when debt is expensive. Buffett hates these companies. He calls them chain letters. They depend on constant acquisitions to hide the lack of organic growth. Examples include funeral home chains, veterinary clinic aggregators, and some software conglomerates. When the debt becomes expensive, the acquisition machine stops. The growth stops. The accounting tricks are revealed. The simulation. You own a company that owns 50 dental practices or 100 veterinary clinics. It grew 20% a year by buying mom-and-pop shops. In 2026, the cost of their debt explodes. They can't buy any more clinics. Their organic growth is actually negative, 5%. Wall Street realizes it was a Ponzi scheme of debt. The multiple collapses from 30x earnings to 8x earnings. The stock drops 75%. Your action: avoid companies with high goodwill on their balance sheet and a history of serial acquisitions. Look for organic growth. Rule number 4. The moat must be pricing power. If a company has debt, it can survive if, and only if, it can raise prices to cover the higher interest payments. This is pricing power. Buffett owns Coca-Cola. If Coke's debt costs go up, they raise the price of a can by $0.05. Nobody stops drinking Coke. They pay the debt. A zombie company selling a commodity product like generic clothes, solar panels, or basic materials cannot raise prices because competitors will undercut them. They have no moat. The simulation: inflation is sticky. Rates stay high. The zombie solar company tries to raise prices. Customers switch to a cheaper Chinese competitor. Revenue falls. Debt kills them. Coke raises prices. Customers complain but keep buying. Revenue rises. Debt is paid. Your action: only hold companies that have a monopoly or a brand so strong that customers cannot switch. Rule number 5. Be the vulture, not the carcass. This is the psychological rule. Most investors try to save their losing positions. They average down on the zombies hoping for a bounce. They think, it can't go lower. Buffett does the opposite. He lets the zombies die. He waits with his cash. He has zero emotion. When the bankruptcy is announced, he buys the assets from the bankruptcy court, or he buys the bonds of the survivor who takes the market share. Your action: stop trying to catch falling knives. If a stock is down 80%, it is not cheap. It is likely going to zero. Sell it, take the tax loss, and keep the cash ready to buy the best-in-class competitor who will pick up the pieces. But here is the plot twist that makes the 2026 crisis different from 2008. The zombies aren't just hiding in the public stock market. They are hiding in your safe, high-yield income funds. For the last 5 years, Wall Street has sold billions of dollars of private credit funds to retail investors. These funds lend money to companies that banks rejected. They lend to the zombies. They promised you 10% yields with low volatility because the assets aren't traded on a public exchange. They don't mark the price down every day. It is a black box. The twist: the maturity wall hits private credit hardest. These private loans have floating rates. As rates went up, the interest payments for these private zombies doubled. They are defaulting right now, but the funds aren't marking down the value because they don't have to report daily prices. They are extending the loans, extend and pretend, to hide the losses. In 2026, when investors try to pull their money out of these private credit funds to pay bills or rebalance, the funds will put up gates. They will freeze withdrawals. You will discover that your steady income fund is actually a portfolio of defaulted loans to bankrupt software companies and gym chains. Buffett avoids private credit. He lends to the US government, treasuries, not to private equity failures. He knows that yield is not free. High yield means high risk of total loss. Let's look at what Buffett is actually holding to survive the zombie apocalypse. He is not just in cash. He owns businesses that are anti-zombies. Insurance: Geico, Chubb, Berkshire Re. Insurance companies hold massive amounts of bonds. They benefit from higher rates because they earn more on their float, the premiums you pay before you make a claim. They have no debt. They have liabilities that they pay later. They are cash-generating machines. Railroads: BNSF. You cannot build a new railroad. The capital cost is too high. The debt is locked in for 100 years. It is a physical monopoly with infinite pricing power. If you want to move goods, you pay the toll. Energy: Occidental Chevron. Oil companies have spent the last 5 years paying down debt. They learned their lesson in 2020. They are the cleanest balance sheets in the S&P 500 right now. They are cash machines. He is betting on low debt plus high cash flow plus physical assets. He is shorting high debt, no profit, plus digital hype. The blast zone for 2026 is the Russell 2000 small caps. The biotech sector burns cash, needs debt to survive, and the SaaS, software as a service sector, unprofitable growth. Now we summarize the survival plan based on the maturity wall reality. The title says, they are dead, so how do you stay alive? Action 1, the Z-score purge. Use a stock screener, like FinViz or your broker's tools. Filter your portfolio for the Altman Z-score. This is a proven formula that predicts bankruptcy probability. If any stock you own has a Z-score below 1.8, it is in the distress zone. Sell it immediately. Do not ask questions. Do not hope for a turnaround. Get out before the filing. Action 2. Dump the junk ETFs. If you own ETFs like JNK or HYG, high-yield corporate bonds, sell them. These ETFs own the debt of the zombies. You are lending money to the companies that are about to fail. When the zombies default, these ETFs will crash 20% or 30%. Move that money into SGOV or BIL, Treasury bills. Trade junk for sovereign. Action 3. Rotate to quality factor ETFs. If you want to stay in stocks but don't know how to analyze balance sheets, let an algorithm do it. Move from growth ETFs, like RKK, to quality ETFs, like Qual, Kawazi, or MOT. These funds specifically filter for companies with high free cash flow, low debt, and high return on equity. They do the Buffett work for you. They are the automated survival portfolios. Action 4. Check your income funds. If you have money in a private credit fund, a non-traded REIT, or any high-yield alternative investment platform that promises 10% returns with no volatility, try to get your liquidity out now. The gates are open today. They will be closed in 2026. Do not be the last one trying to exit the burning theater. Action 5. Be patient with cash. Buffett is holding cash to buy the survivors. When the zombies go bankrupt in 2026, they will sell their assets, buildings, patents, inventory, for pennies. The companies with cash, and you, with your cash, will be able to pick up incredible bargains. The wealth transfer happens at the bottom, not the top. The final verdict on the maturity wall of 2026 is a call to financial hygiene. The era of profitless prosperity is over. The tide is going out, and we are about to see who is swimming naked. The zombies will die. It is a mathematical certainty. They cannot refinance at 10% yields. The math does not work, but you do not have to die with them. Warren Buffett has moved to high ground. He is watching the floodwaters rise from his fortress of cash and quality assets. He has done the work to ensure he is on the right side of the transfer. You must do the same. Clean your portfolio. Cut the dead weight. Focus on survival, cash flow, and solvency. Be like Buffett. Ruthless in your analysis, patient in your execution, and totally unemotional about cutting losers. The bill is due. The wall is here. Make sure you're on the right side of it. I am immensely grateful to you for staying until the end of this critical warning. Understanding the difference between a stock, a ticker symbol, and a company, a balance sheet, is the key to surviving 2026. If you found this breakdown valuable, make sure to like and subscribe so we can keep bringing you the truth about the financial system that the brochures leave out. Stay vigilant, stay solvent, and we will see you in the next video.